All right, the market is digesting this morning's jobs data, continues to do that. Chicago Fed President Austin Goolsbee talked to Yahoo Finance earlier today, sharing his feeling and his perspective on the January jobs report.
We may be on hold, but I see over the next 12 to 18 months, if we can get out of the uncertainty coming from policy or from geopolitics and commodities, I view the long run settling rate for the Fed funds rate to be a fair bit below where it is today.
For more, we're bringing in Greg Daco, EY Chief Economist. Greg, it's good to see you. You know what? I'm going to do a little bit of an audible here, because we just heard Austin Goolsbee talking about rates going lower. But man, people, individuals, consumers, they are not expecting inflation to go lower. We learned from that University of Michigan report today. That seems to be the real shock to the market and to sort of the economic paradigm today. What did you make of that?
That's right, Julie. I mean, we have an environment in which the expectation of tariffs, potential tax cuts, and deregulation are seen all as inflationary. And that's a little bit of the paradox, because there was this sentiment up until the election that inflation was a key concern coming from the general public. So having these inflation expectations that are rebounding very aggressively, you saw the University of Michigan 1 year ahead inflation expectations surge 1 full percentage point in early February. Those are not encouraging, because they tell you that consumers are going to be much more judicious when it comes to their outlays. And even though we still have a robust labor market, as was shown this morning in the data, we have to be conscious of the potential risk for a downside there in a higher inflation, lower growth environment.
Greg, on that sentiment data, that jump in 1 year inflation expectations you're calling out there, which, as you know, eye-catching, unusual, what do we attribute that to, Greg?
Well, I think it was largely attributable to the fact that people were looking at the announcements on the policy front and the expectation of tariffs raising or leading to an increase in consumer prices. I think we are now in this environment where more and more consumers are in tune with the fact that if you impose tariffs on your trading partners for automotive goods, for agricultural products, for furniture, those prices of those items will go up, and that will lead to higher inflationary pressures. That's really what the University of Michigan Consumer Sentiment Survey was indicating. Encouragingly, though, we still have that robustness in the labor market, and we still have the luxury of non-inflationary wage growth that is coming from the labor market and supporting incomes, which in turn are supporting consumer spending. So we're not at risk right now, but there are some potential cracks there forming.
Well, Greg, and that raises the question, too, of, the whole argument over the balance between tariffs being inflationary, but also being a risk for growth. It sounds like you're not worried about the growth side at this point.
Well, at this point, not yet. But if you factor an environment in which prices are rising, that will be fed through to consumers. We know that we're coming out of an unusual period of high inflation where pricing power surged to levels that we had not seen in multiple decades. So if we are to see this environment where tariffs are imposed on our major trading partners, whether it's China, Mexico, Canada, Europe, that will lead to higher producer prices, which will be passed on to consumers. And in an economy that is evolving close to full potential, as Austin Goolsbee was saying earlier, we have a labor market that's also close to full employment. In that type of environment, any type of supply disruption risks creating more inflationary pressures and becoming a hindrance in terms of economic activity, and therefore a drag on economic activity. So I think we very much have to be conscious of this potential hit to economic activity from tariffs.
Greg, back to the jobs report. I think broadly solid, investors seem to take it in stride. How do you as an economist see that labor market evolving in 2025, Greg? Or is it tough to say with any degree of great confidence until you get more clarity about immigration policy?
There's a lot of uncertainty, certainly, Josh. But if we have to describe this labor market, I would essentially say that it's robust but frozen. We have job growth that is still relatively steady. If you look at the 12-month moving average, it's around 170,000 jobs per month. You have an unemployment rate that is everything that you want it to be. It's reassuring, it's driven by a high labor force participation rate, and it's at a historical low of 4%. These are very encouraging indicators. But there are some elements that we have to focus on. Hours worked fell to their lowest level since the COVID crisis. You have an environment in which you're seeing less diffusion of job growth across sectors. And the January report was slightly softer. So there are signs that businesses are being cautious with their hiring decisions. They're not firing and laying off individuals without discernment. They're being very strategic with those. But at the same time, they're also being very strategic with who they hire and at what rate they hire. And that is the type of labor market that's frozen that we're currently seeing.
And is that a function, Greg, of what's going on in Washington? Is that a function of economic conditions, some combination of the two? What do you think?
I think it's a combo of the two, because we were already starting to see the initial elements of this frozen labor market over the course of the past year. If you look at the hiring rate or the quits rate, there's much less churn today than there was a year ago, 2 years ago. And even if you look at these rates, they're at a decade low. So these are indications that the labor market has been cooling for the better part of the past year. But add to that the uncertainty with regards to policy. What type of trade policy, tax policy, regulatory policy, immigration policy environment we're going to see over the next year, over the next couple of years. And that makes it very difficult for business leaders to decide whether to pursue growth strategies, invest more and hire more, or adopt more of a wait and see approach. And I think right now, the latter is still dominating. A little bit of that wait and see approach until they know what type of policy environment they'll be facing for the next few years. And unfortunately, that's to some extent restraining economic activity in the early stages of this administration.
And it's also not clear when exactly all of that will be settled, Greg. So I guess we'll catch up with you again soon as we make progress, hopefully.
For sure.
Thank you.